There's this very specific script that we've all been handed about retail.
Mm-hmm. The retail apocalypse.
The retail apocalypse, exactly. It's been drilled into our heads for, what, a decade now? You open up a news feed, and it's always some version of the same headline.
It's the standard obituary for the American mall, yeah.
Right. We're supposed to picture, tumbleweeds in the food court, empty parking lots.
The assumption being we're all just ordering everything online now.
Exactly. That we'll just sit in our living rooms forever. That's the story we're telling.
That is definitely the prevailing mood.
But then,
yeah.
But then you get a document like the one we're looking at today. We did a deep dive into the Q4 and full year 2025 earnings from Simon Property Group.
The biggest mall operator in the country.
The biggest. And looking at these numbers they just dropped yesterday, that was Monday, February 2nd, I have to say, it really doesn't look like an apocalypse.
No. It looks a lot more like a victory lap.
So that's our mission today. We're going to try to ignore the stock ticker and just look under the hood. We need to figure out, is the mall actually back?
Or is it something else entirely?
Yeah, because when you look at the new tariffs, their strategy for building these like mini cities and this absolutely wild financial chess move they pulled with Saks, it feels like the very definition of a mall is changing right under our feet.
I think that's the perfect way to frame it. It's not about the mall coming back to what it was in, 1995.
Right.
It's more about it mutating into something totally different. And the data from yesterday's call with CEO David Simon, well, it makes that incredibly clear.
Okay, so let's start with the headline numbers. Because if this industry is dying, somebody forgot to tell Simon's accountant.
Uh-huh. Clearly. So the number that really, really matters here, it's sort of the holy grail for a real estate investment trust, or
is something called FFO.
FFO, Funds from Operations.
Okay, let's pause there for a sec. For anyone listening who doesn't spend their day staring at REIT balance sheets, why FFO? Why not just look at net income like a normal company?
That's a great question. So in the world of real estate, standard accounting forces you to calculate something called depreciation.
Right, where you pretend your buildings are losing value.
Exactly. You have to pretend they're losing value every year, which counts as this huge paper expense. But in reality, good real estate usually goes up in value.
Or at least stays stable.
So net income ends up looking artificially low. FFO basically adds that fake paper loss back in. It tells you the actual cash-generating power of the properties.
Got it. So it strips out the accounting noise and just shows us the cash. So what was the cash-generating power for 2025?
A record. $4.8 billion. That comes out to 12.73 cents per share.
Almost $5 billion in cash. For a supposedly dead industry.
And they finished the year super strong, too. For Q4 alone, they beat Wall Street's expectations. The consensus was, about $3.47 a share? Simon delivered $3.49.
And the revenue.
Revenue for the quarter was $1.79 billion, which beat estimates by almost $300 million.
See, that revenue beat is interesting. It tells me this isn't just, financial engineering or cost cutting. They're actually bringing in more money at the top.
Precisely.
Yeah.
And that brings us to what I think is maybe the most surprising stat in the whole report. If you think malls are empty, chew on this. In 2025, Simon Property Group signed 4,600 leases.
4,600.
Yep. And that covers 17 million square feet of retail space.
I'm trying to visualize that. Give me some scale.
Okay, think of it this way. The Pentagon is one of the biggest office buildings in the world, right? 17 million square feet is like 3 Pentagons.
Wow.
Or about 300 football fields of pure retail space, all leased in 1 year.
But here's the skeptical question, right? Are they leasing it out of pure desperation? You hear stories about landlords just giving away space to keep the lights on so it doesn't look like a ghost town.
That is the critical distinction, and the data here really shuts that idea down. Simon disclosed that the base rent on these new leases is around $65 per square foot.
Is that good?
It's excellent. It's a premium price. It tells you that retailers, the people who actually see the foot traffic, the sales data, are willing to pay top dollar for these specific spots.
They're not doing it as a favor. They're doing it because that's where the money is.
The demand is robust. Look at their occupancy rates. Their malls and premium outlets are at 96.4%.
96%.
And if you look at the mills, those are their huge outlet hybrid centers. They're at 99.2% occupancy.
99.2 that's effectively full. There's no vacancy.
You couldn't squeeze a pretzel stand in there. So the takeaway from the top-line data is, well, it's pretty unambiguous. The consumer is still showing up, and retailers are fighting for the space to sell to them.
Okay, so the apocalypse is canceled, or at least postponed. But we have to be nuanced here. Not all malls are created equal, right? I can drive past some zombie malls that are definitely not 99% full.
And this is the second huge theme of the report, this flight to quality. Simon isn't winning because all malls are winning.
They're winning because they own the best ones.
Exactly. And the competition is just dying off.
They spent a lot on acquisitions in 2025, about $2 billion. What were they buying?
Trophy assets. Pure and simple. They didn't go buy a struggling Class C mall in some shrinking city. They bought the mall in Florence, Italy.
Which is a world-famous luxury outlet.
Right. And they bought a stake in Brickell City Center in Miami.
One of the hottest markets in the country.
It is. And they bought the rest of Taubman Realty Group to get full control of those high-end assets. It's a consolidation of power. They're betting that in a digital world, the only physical retail that really survives is the A-list stuff.
It's interesting to use the word destination because that leads right into their development strategy. They've got a $4 billion pipeline, but they aren't just building more stores.
No, not at all. This is where that concept of the mall really starts to break down. They are turning these places into mixed-use ecosystems.
We hear mixed use a lot, though. It feels like a buzzword. Yeah. Like, oh, put a condo on top of the Chipotle.
Right, but Simon seems to be doing it at a scale that actually changes the geography of a town.
How so?
Well, think about it. A traditional mall is just a giant box surrounded by a sea of asphalt parking.
A terrible use of land.
A terrible use of land. Someone's looking at all that asphalt and saying, why isn't this a hotel? Why isn't this an apartment complex?
They mentioned Northgate Station and Lakeline Mall specifically for this.
Yeah. Adding hotels, adding residential units, and the genius of it is circular. If you build 500 apartments next to the mall, you've just created a 1,000 built-in customers who can walk to your tenants.
You create your own foot traffic.
You do. And they brought up Southdale Center as the perfect example of this. Now, Southdale is historic, right? First indoor mall in the U.S.
It was. And for a while there, it looked like a dinosaur. It was a C asset. Herberger's a department store went bust. The JCPenney was empty.
In the old narrative, that's the beginning of the death spiral.
But Simon flipped it.
They saw the failure of those department stores as a feature, not a bug. It let them reclaim the space. So they put in high-end luxury retail. They put in a Lifetime Fitness Center.
Which brings people in every single day, not just once a month.
Exactly. Now they consider Southdale an A asset. It's almost like the department stores were holding these properties back.
In a lot of ways, they were. Taking up huge space, paying very little rent, replacing that with a luxury wing and a gym is a massive upgrade in profitability.
David Simon had a really colorful way of talking about this on the call. Did you catch that reference to the show Landman?
I did. That was a great moment. He was comparing their assets in Midland, Texas, deep oil country.
To Short Hills, New Jersey, which is probably the wealthiest luxury mall in America.
It's a pretty wide spectrum.
It is. But his point was, whether you're in Midland or Short Hills, the goal is to be the absolute best version of that specific thing. He wants the Midland Mall to be the pride of that blue-collar, oil money community.
He's not trying to put a Gucci in Midland.
And he's not putting a Tractor Supply in Short Hills. It's all about curation. And that ability to operate across that whole spectrum is what separates Simon from the smaller guys.
Okay, so we've got record cash flow, smart acquisitions, a solid strategy. But I want to pivot to the real talk part of the call. Because Simon is known for being blunt, and he did not sugarcoat the headwinds, specifically tariffs.
This was the most cautionary part of the whole discussion. And it's important to understand what he was actually saying. He wasn't complaining about politics. He was analyzing the plumbing of the retail economy.
He drew a really sharp line between the giants and the rest of us.
Yes. He basically said, look, Costco, Walmart, Amazon, they're going to be fine.
They have the scale to absorb it.
They have the scale, or they have the power to just squeeze their suppliers to eat the cost. They're immune.
But the rest of us, meaning the specialty retailers that actually fill the hallways of a Simon Mall, the Gaps, the Abercrombies,
they're in the crosshairs. He gave this startling example with a company called Catalyst. He estimated that new tariffs could strip $200 million of EBITDA, that's earnings,
right out of a company like that.
Just to pay the government. And $200 million isn't a rounding error. That's their profit margin.
So if that money goes to tariffs, it doesn't go to rent.
It doesn't go to rent. It doesn't go to renovating stores. Simon was very clear. This creates credit risk. He said their guidance for 2026 actually bakes in the assumption that some of their tenants will go bankrupt specifically because of this pressure.
Wow. That's a sober reality check. It's a K-shaped impact. Big get bigger, middle gets crushed.
And there was another fascinating ripple effect of this tension. Did you catch the part about the borders?
The Canadian shoppers, that was wild.
Yeah, we always hear about the southern border, but Simon pointed out that traffic near the Canadian border is surprisingly weak. And his quote was that the Canadian shoppers are really pissed off.
Which implies a sentiment shift. Maybe they're staying home because of political rhetoric or new tariffs.
Meanwhile, southern border traffic is booming. It just shows how macro politics trickles down to whether someone drives across a bridge to buy a pair of sneakers.
Okay, so tariffs are a threat. Interest rates are another. They said that'll cost them 25 to 30 cents a share in 2026. But despite all that, they made this massive, confusing financial move in Q4 with Saks and Neiman Marcus. I want to deep dive on this because on the surface, it looks like they just lit $100 million on fire.
This is the masterclass section of the deep dive. This is where the finance gets really, really interesting.
All right, set the scene for us.
Okay. So Simon made a $100 million investment related to the merger between Saks and Neiman Marcus. Then, in the fourth quarter, they wrote that investment down to zero.
Wrote it off. Gone.
Poof. On the income statement, yes, it looked like a total loss.
I mean, if I told my boss I invested $100 million and lost it all in 3 months, I'd be fired. But Simon seemed happy about it.
Why? Because it wasn't about a cash return. They made the investment to buy control. You have to look at what they got in exchange for that money. It wasn't a stock dividend. It was a get-out-of-jail-free card.
What were they in jail for?
They were handcuffed by something called an REA, a reciprocal easement agreement.
That sounds incredibly boring and also incredibly important.
It is the invisible force field that governs malls. Decades ago, department stores were kings, and they signed these agreements that gave them veto power. If Simon wanted to knock down a wall or redevelop the exterior, they needed the department store's permission.
So if Simon wants to build those apartments we talked about, and the Saks building is in the way, Saks could just say no.
Saks could say no, or, more likely, pay me $10 million and I'll say yes. It was a hostage situation.
Ah, I see where this is going now.
By making that investment in the Saks-Neiman deal, Simon negotiated the removal of those handcuffs. Across their entire portfolio, they now have the unilateral right to redevelop those anchor boxes without asking permission.
That's huge.
Yeah.
They paid $100 million to unlock billions in potential development value.
Exactly. They sacrificed a pawn to control the entire board. And they got more than just that. They also got the right to terminate leases on 2 specific buildings if the tenant is in monetary default, which, by the way, they noted these tenants are.
So they can take those buildings back immediately.
Immediately. And they even got some IP out of it, too.
Right. They converted the investment into an ownership stake in the intellectual property of Saks, Neiman Marcus, and Bergdorf Goodman.
This is the part that blows my mind. The landlord now owns a piece of the brand name of the tenant.
It's vertical integration.
It is. This IP is managed by Authentic Brands Group, which Simon also owns a big chunk of. So they collect the rent, they own the brand name on the door, and now they can tear the building down and build a hotel if they want.
That completely changes the power dynamic. It's total control.
It is a landlord taking control of their own destiny.
So with all these pieces in place, the strong leasing, the new development rights, what are they telling us to expect for 2026?
They're guiding for FFO between $13 and $13.25 per share.
So growth.
Growth, yeah. Even with the headwinds from tariffs and interest rates, they expect domestic property income to grow by at least 3%.
And they're trying something new to drive that, right? This Simon Plus thing.
This is an experiment to watch. Historically, Simon is a B2B company. They rent space to The Gap. The Gap deals with the customer.
But Simon Plus is a loyalty app that tries to go direct to consumer.
Exactly. Right now, it's about rewards and engagement. But the long-term play here is data. If Simon can track who you are and what you buy, they stop being a passive landlord. They become a data platform.
So they can go to their tenants and say, we don't just give you 4 walls, we give you customers.
That's the idea. And they need that leverage because the environment is tricky, but, and this is a big but, luxury seems to be immune.
Yeah, they mentioned a new Chanel boutique opening in Boca Raton.
David Simon made a point about this. He said brands like Chanel, LVMH, they aren't panicking about 2026. They're taking a 10-year view. They're investing heavily in their physical stores because for luxury, the store is the product.
You don't buy a $10,000 handbag on Amazon.
You buy it in a beautiful room with a glass of champagne, and Simon is the one building that room. And they're backed by a fortress balance sheet. They have $9 billion in liquidity. In a high-interest rate world, cash is king.
Okay, so let's wrap this up. We started by asking if the mall is dead.
And the answer seems to be the old mall is dead. The generic, boring, mid-tier box is absolutely dying.
But it's being replaced by something else. This mixed-use destination, it's condensing. The weak malls close, the weak retailers get wiped out by tariffs, and the strong assets, the ones Simon owns, just get stronger.
It's a story of consolidation and evolution. Simon is buying the best, building apartments on top of them, and taking ownership of the brands inside them.
It really forces you to rethink what this company even is. I mean, if Simon owns the real estate, builds the apartment you live in, owns the hotel your family stays in, and owns the IP of the department store where you shop, are they still just a landlord?
Or are they becoming the mayors of their own privatized mini-cities?
That is a fascinating and maybe slightly dystopian thought to end on. They control where you sleep, where you shop, and the brand on your shopping bag.
It's Simon's world.
We're just shopping in it. Thanks for diving deep with us today. We'll see you next time.